Good afternoon, everybody, and welcome to the Equifax Market Pulse, where we're going to be talking you through the Q1 consumer credit trends. For those of you who haven't met me before, my name is Becky Oakes. I'm the Vice President of Analytics here at Equifax, and I'm delighted to say I'm joined today by two colleagues, Bill Johnston, who's our SVP and Chief Product Officer, and Kathy Katsouleris, who looks after our consulting team. So before we get started, I'm just going to hand over to Sandra to give you a bit more information about the On24 platform. Sandra.
Thanks very much, Becky, and good afternoon, everyone. Each area within the On24 webinar platform is responsive, so you can maximize or minimize each widget or box on your screen based on your viewing needs. There's an Ask a Question widget underneath the media player, so feel free to enter any questions you may have, and we'll try to address them throughout our session today. In the event there's too many questions to get through, we'll reach out to you individually to follow up in the coming weeks. Our presentation and some related content in English and French are available for download in the related content area, and our session is being recorded, so you'll receive the on-demand link via email tomorrow. We'll also have some polling questions today, so keep an eye out for those. You can provide your answers right within the platform by selecting the appropriate option when it appears on your screen. Some additional features you'll notice on the bottom of your screen are reactions. Let us know how we're doing. Register now for our upcoming Business Trends webinar on June the 20th, our survey as always, and contact us. Feel free to check any of these out and provide your feedback. We'd really appreciate it. Now let's get started. Bill, over to you.
Thanks, Sandra. Thanks for joining us today, everyone. We've got a pretty exciting time in the economy. If you want to call it that, a lot of people may not find it as interesting as I do, but lots of things happening right now. We finally saw the Bank of Canada lower interest rates after having risen them for the last 2 years. Lots of conversations about the housing market and how we can sort of deal with high house prices and affordability. We saw the recent announcement in the budget around capital gains tax. So lots and lots of great activity happening in the marketplace. But what does that really sort of meaning for us, and what's really behind the economic numbers? I think, when we kind of look at the overall numbers, they actually look fairly good. GDP growth, employment, all the numbers at a headline are really good. But quite often when you dig behind them, they're not quite as strong as we hoped they were. So one of the key drivers really of the market so far has been population growth. Been all over the news, all over the media. We've talked about it lots of times. But the reality is just we've had so many newcomers into the country has really been driving sort of that top line aggregate numbers. When you see a big number going up, it's a lot of times it's just more people doing stuff as opposed to individuals acting and doing more things on their own. And we see that even regionally, we can tell their specific regions are outperforming primarily just because of this influx of people relative to some of the other markets. And so what we know particularly from a credit perspective is that has a real influence on things, right? We have a lot of people with no scores or relatively new scores. They're probably lower than normal. We know new immigrants actually tend to perform better than their scores suggest, at least at the beginning. And so we've got a lot of people who are trying to deal with this influx of people and help them get acclimatized to Canada. And more importantly, make that first few months, the first year really, really positive. So we're keeping people in country, kind of getting the long-term economic benefits of what we wanted. But the reality is a lot of this is changing depending on where you are. No surprise, BC and Ontario have a lot of new immigrants from outside of Canada, but somewhere like Alberta has actually been primarily across provinces. And so many of you would have heard the radio ads that come back to Calgary, come back to Edmonton. Alberta was really, really good house prices. So it became a bit of an affordability issue. And so what we saw differently is actually was people moving province to province, where in Ontario or BC, you may be facing a slightly different problem from a lending perspective in that you've got new Canadians, in Alberta, it's a little bit different. But at the same time, it's still driving very strong economic growth. And so when we look at this regionally, somewhere like Quebec, which really hasn't had as strong international immigration or interprovincial, tends to be lagging the national average as a result. It just shows you the influence of population and how that's really been driving a lot of our numbers. So the reality is, we got our GDP number at the end of last month. It was a little bit lower than expectations, primarily because we had a very strong January monthly number came out. I think people thought that, we went into February was pretty good. We expected March to be flat. So a little bit of a surprise, the GDP was a little bit lower than expected. 1.7 is still relatively good. If you kind of look at the previous couple of quarters, it's significantly better. There were some one-offs, some of the strikes that were happening in Q4 kind of got resolved and we're kind of ramping up in Q1. And so we know that there was a little bit of sort of leftover. That's primarily why January was such a strong month. One of the things that we did look at that was somewhat concerning is that while the number was below expectations, actually Q4 number was revised down fairly significantly. So not only did it not grow as fast as we thought, but it actually was coming off a lower base. So you would have expected a little bit more strong growth. But overall, the headline number is really decent. I mean, given where we're at with interest rates, sort of 1.5% plus growth is actually not bad for us right now. But the reality is it sort of masks, again, because of that population, what's happening at an individual level. So when we look at GDP per capita, that's on a steady decline. It has been for some time, primarily, once we started to increase interest rates. And so while the aggregate's moving up just because you have more people, the reality is individuals we deal with on a daily basis may not be feeling as positive. They may not see the benefits of economic growth the way others have just because this per capita number is coming down. You've heard lots of conversations around Canadian productivity, whether or not we're losing because of this. The reality is part of it's just because you're integrating a lot of new people into the country that long-term will provide productivity. We know that from a population perspective, we need to have these new immigrants coming in to bring in the right skills, the right people that we need. But in the short term, we definitely are seeing that where the growth is, while positive, should be much stronger when you account for that population growth. We also see that in the employment market. So new jobs have been really, really strong, actually, in the first 4 or 5 months of 2024. Probably surprisingly strong. We had 1 month of 90,000. Even last month, where they said it was flat, it was still 20,000 jobs, which in the grand scheme of things for Canada is actually not a bad number. But again, when you compare this to population growth, we often look at employment rate as opposed to unemployment rate. So that's the percentage of the population with a job. It, again, has been steady decline. So despite the fact jobs have been growing quite well, actually even job growth hasn't been keeping up with population. So what that means is where we went from a massive surplus of job vacancies at one point kind of in 22, we pretty much had one job vacancy for every unemployed person in Canada. Job vacancies are sort of back down to normal levels. Still around 500,000 or 600,000, but given the population size. So, the employment market has got much more balanced. We definitely are seeing an increase in terms of unemployment rate. But again, a lot of this is just being masked by the fact that a lot of the growth is just have more people entering. And it depends regionally, again, what's happening. But you can see the markets that have had the strongest population growth, Ontario and BC in particular, where we have seen sort of a bigger decline in that employment rate. So again, when we kind of think through policies, when we think through strategies, we have to sort of account for the fact that a lot of the growth is coming from groups that may not look like the average anymore because of that. And that some of these people actually at the margin maybe aren't having as strong a sort of financial time as it seems, given that we've had this sort of mask from the population growth. The big question really has been the Bank of Canada. I think everybody's sort of been waiting for it for some time now. I think no one was too surprised by the 25 basis points last week. I think there was some debate whether that would wait till July. I think the good news was a lot of the underlying numbers have actually been relatively positive from a Bank of Canada perspective. So if you look at it from an inflation perspective, if you actually just take out mortgage interest costs, which again is being driven by Bank of Canada policy, we're actually down to the 2%, actually below the 2% sort of level that they're targeting. So when you kind of look at the factors, we actually are seeing a good moderation. Most of this is really interest rate driven, which should sort of weigh out once sort of the rates have sort of become steady. And so what we're starting to look at is what really happens to these new price levels. We all sort of saw the grocery prices. We've all heard about it in the news, lots of talk about that. But the reality is, they're not about to come down. So the growth rate in inflation for food may slow down. But, the challenge that you start to run into is if prices start to decrease, you get into what's a deflationary cycle, which is actually just as bad, if not worse than inflation. So, I think prices are where they are. And now the growth rate will really moderate, which will give the Bank of Canada some room. So I do expect they will continue to cut rates. They've been very clear. It is going to be slow and steady. I think there's lots of question about what happens to the market, particularly the housing market. How quickly will this respond to those lower interest rates? And so they want to make sure that they're not reigniting anything. They have a challenge with the U.S. economy as well. It continues to grow at a much better pace than Canada. The Federal Reserve, which had said they were going to cut rates fairly aggressively, really have got to a point where they've had to delay. They're probably going to delay well into the back half of this year. And so the Bank of Canada can move a little bit on their own, but at some point in time, moving too far ahead of the Federal Reserve is really going to deteriorate the Canadian dollar, which, given the amount of imports we have here in Canada, will actually drive inflation. And so there'll be a little bit of a guardrail around what the Bank of Canada can do. But if not in the next meeting, likely in the following meeting, we will see another 25 basis points. And so it'll continue to come down, just given that inflation really has leveled off to where they think that they've got the trend headed in the right direction. There may be some one-offs, but really the trend overall is really moving forward. And so Bank of Canada likely sits in a spot where they can start to move a little bit more aggressively, but caution will be the main thing. Again, because the population, the challenge for the Bank of Canada is weighing the fact that this aggregate number looks really good, but underneath it maybe it's there's more strain than you think, has really been sort of part of the factor. And so I think as we continue to see that, and if we see that leveling off, we'll start to see that growth and back to sort of lower interest rates. So one of the things that has helped the economy fairly significantly is just the fact that while inflation's been really strong, so has employment growth. So disposable income in particular has been really strong right from sort of 2020. The early days in COVID had just a lot to do with benefits and CERB and things like that really drove numbers up. But from that point, again, just because you have so many more people employed, really we've seen very, very strong growth in income. And so when you kind of look at the facts, you compare CPI change to income, actually income has grown faster overall, again, on an aggregate level. But even at the household level has really sort of kept pace with inflation. So that's really helped. The challenge you run into with that is not going to be felt the same for everybody, right? So high income households will really have done very, very well, but medium to low income, probably not as much. And so you're starting to see that separation between the groups, particularly when you're in a credit environment, understanding that split becomes more and more important. Our data has shown, I'm sure Becky will talk about it, that non-mortgage holders has really been the challenge for sort of sustainability. I think everyone expected higher interest rates. Mortgage holders are really in trouble, but really it's the cost of living on the non-mortgage group that's really been weighing on people. So you sort of start to see those split in people. And then the other thing that we have sort of underneath all this is a fairly big bucket of excess savings. So if you kind of think back, it's hard to believe it was 4 years ago, but 2020, we're all locked up at home. We're not really spending a lot of money. We started to build a lot of savings sort of in that 2020 period. But the savings rate in general has really not come back down to the pre-COVID levels. It's stayed above that. And so you've got a big bucket of excess savings that people have been able to offset a lot of the cost of living. They've been able to offset higher interest rates. But what we see when we look at those numbers is that when you look behind it, it's a bit of an isolated group. So, 75, 80% of the excess savings is sitting with the top 20% of income earners. So, it's not like this is being felt again across the entire spectrum. The wealthy and high income, again, have really, really benefited. But that's really what's helped sustain us. What we do know is, and lots of headlines talk about, the real mortgage wave is about to come for renewals, likely 25 and 26. The fortunate thing of the last 2 years has really been the fact that the mortgage renewals are coming from a time right after the stress test was deployed. So we saw that drop in mortgage volume. So renewals haven't been quite as strong, but that wave will pick up. So hopefully that we'll see that the higher income and the savings will sort of benefit that, but we will start to see some of that strain coming through as more and more mortgages renew in 25, 26, depending on how aggressive the Bank of Canada gets. So really, when you kind of think it in the credit context, what we're seeing is really a sort of spectrum of people where there's a certain segment, high scores, high income, doing very, very well. But as you kind of go down that income scale, you start to see where the challenges are. And while the Bank of Canada changes will help, for a lot of those people, it really was cost of living. It wasn't really the cost of interest. So, it's interesting to see, and as we think through, making sure we're aware of the groups that we're dealing with will become increasingly important. So I'm going to hand it over to Becky so she can talk about what's actually happening in the credit market.
Thank you so much, Bill. So as Bill just mentioned, there's quite a lot going on the economy side of things, and this is really starting to impact certain pockets of the credit industry. So the three main key themes that we're going to be talking about today. First one is really how are consumers starting to adapt to these changing economic conditions, and we're starting to see some of their behaviors switching a little bit more from what we've maybe seen in kind of historic times where we've had interest rates going up. Second thing is really around what's happened in the mortgage industry. As Bill mentioned, we know we've had a lot of renewals coming through, and with those high interest rates, that's leading to payment shocks and some of the knock-on effects that continues to have. And then in general, just what's happening in terms of financial stress. We are unfortunately still seeing that continue to pick up pace. So at an overall level, consumer debt sitting at around $2.45 trillion. In the last 12 months, we've actually seen faster growth on the non-mortgage side compared to mortgage, which is a little bit different compared to what we were seeing during the pandemic, where the house prices in certain markets and those low interest rates really fueled a lot of growth in the mortgage base. On the non-mortgage side of things, the card continues to be the choice in terms of what consumers are using more and more. When we look at kind of compared to year on year, it's up around 15% in terms of balances. And then it's actually up this quarter ahead of what we'd normally expect from a seasonality standpoint as well. We are seeing some of the other products actually starting to reduce a little bit though in terms of balances compared to 12 months ago. So loans in particular and home equity lines of credit. And we'll talk a little bit more about some of those coming up. From an actual consumer standpoint, though, when we start to look at who is actively using credit, what we did see last year, linked to what Bill was talking about in terms of immigration and population growth, we saw much faster increases in terms of credit usage for those individuals with newer credit files. So open that credit file in the last 12 or 24 months, some of that being immigration, some of that being new to credit, but that's really where we saw the activity starting to increase. That population growth is slowing a little bit. So we are still seeing that group of individuals move through and they are still very credit active, but we're not seeing as fast a growth in the last 12 months in terms of what's happening with those brand new files that have been opened. When we look at average debt, though, in particular non-mortgage debt and how those individuals are using credit, overall average non-mortgage debt is up at a consumer level, but it's kind of a tale of two stories. A tale of two sides, really. So we have on the newer to credit population and some of those immigration groups, their balances tend to be a little bit lower, but there's a lot more of them. And then when we start to look at more established credit files, those non-mortgage balances are a bit higher. So there are some groups relying more on credit and continuing to increase those balances. And that newer group is kind of bringing that overall average down a little bit. So one of the reasons why we're seeing a bit of shift in behaviour is the interest rates are continuing to have an impact in terms of what it means for a consumer and minimum payments each month. So left-hand chart, you can see this is the minimum payment amount for different product types compared to pre-pandemic. And you can see, particularly on the right-hand side of that chart, the home equity lines of credit, the difference in terms of minimum payments on a monthly basis is significantly higher than it was back when that pandemic started. And that's one of the reasons why we're starting to see maybe some consumers taking a different route, choosing different options, maybe reducing some of their credit usage on certain products. And then for others, of course, they may actually still be continuing because they have no other option but to rely on credit. On a card side of things, when we look at spend, we are still seeing spend levels on cards. They are still much higher than they were before the pandemic, but they really have stabilized. So even backing out for inflation, it's still higher than it was a few years ago, but it is leveling off similar levels to what we saw last year. So when we look at that credit usage a little bit more, we can see, if you actually do have a card in your wallet right now, around 87% of consumers are actively using that card. By that I mean they're spending or they're carrying the balance. That is up 340 bips compared to the similar period pre-pandemic. You can see on that left-hand side, when we look at the lines of credit in particular, and that's really where we've seen a lot more reduction in usage and choice of products by consumers. We see unsecured lines of credit around 46% actively using that line, and on HELOCs around 57%. And they are significantly down compared to where we were kind of end of 2019, start of 2020. Now, that's good news in the sense of maybe consumers are using them less, but where they are using them, we are now seeing balance growth starting to pick back up again. So on the right-hand chart, that blue line is HELOCs. Where there is a balance, that balance is increasing a little bit faster, particularly in the last couple of quarters. And unsecured lines, they're starting to pick back up again to similar levels to where we were before the pandemic. In terms of financial stress, I mean, just overall at a consumer level, and we will dig a bit more into the product side of things a bit later on, we have around 1.26 million consumers that missed a payment on some type of credit in the first quarter. That's up 137,000 compared to the same time last year. Now, when you start to look at the left-hand chart, the good news again is that when you look overall, and the blue line is consumers with no mortgage, orange is with a mortgage. When you look at what percentage of individuals are missing a payment, it is lower than pre-pandemic, particularly in that mortgage population. It is increasing though, and when we start to dig into it, and this is again, it's been a common theme for the last couple of quarters, and it still remains, is that there are pockets of consumers, groups of consumers that are really feeling the financial stress more than others, and there are some which are weathering the storm quite well. So when you look overall, yes, those numbers are going up, but they're compared to 2019, still not too bad. Actually, it's not as rosy when you start to look more at a segment level. The right-hand table, we've just tried to break out a little bit, okay, well, where we are seeing people becoming more financially stressed, where is that happening? And we're really seeing it across certain provinces, as Bill mentioned, Ontario, BC. They're definitely picking up pace compared to 12 months ago in terms of missed payments coming through. And that's both for consumers with a mortgage and without. And we're seeing it more and more, probably unsurprisingly, on consumers that have lots of credit usage. So many different trades, many different products that they're using, perhaps starting to become more overwhelmed with their current financial position. Just briefly touching on insolvency. So I know last quarter we talked about insolvencies had slowed down a little bit. They'd kind of stabilized in Q4. Unfortunately, in Q1, we are seeing consumer proposals pick back up again. Those levels exceeding now in terms of what we had pre-pandemic. At an overall level, though, when you look at total insolvencies, because bankruptcy levels are still low and stable, it's still a little bit lower than we had before the pandemic hit, which is some good news. Again, provincially, we are seeing some of the increases coming through on Ontario and BC. Both of those provinces are seeing insolvency rates at or back above pre-pandemic, along with Saskatchewan. Some of the other provinces, we are seeing those insolvency levels rising, but they're still a little bit lower, which is a positive for those areas. And then finally, just touching on what has all this done to credit scores. So during the pandemic, we actually saw average scores on consumers rising by 10, 11 points on average, which was quite a significant shift. And some of that was due to those benefit programs and the deferral programs that were in place. That has started to come back down again. We are still slightly higher in terms of average scores compared to pre-pandemic. But they are falling as we're starting to see some of these pockets of stress come through. Linked to that, when we start to look at consumers and what they're doing in terms of their credit score, we have seen a greater pickup in terms of individuals more actively checking their credit scores, particularly on the mortgage population, perhaps trying to ensure they are getting those scores in the best position that they can be before they're coming up for renewal, because in a high interest situation with the economic side that Bill mentioned, consumers are really looking for some of the best deals that are out there, and obviously the score is one way to help them do that. Okay, so I'm just going to hand over to Kathy, who maybe can give you a few insights into, as a lender, what might you be wanting to think about right now? Kathy.
Great. Yeah, thanks, Becky. So before I jump to sort of what a lender should be thinking about, I'm actually just going to kick it off with a quick little summary. Some of the key highlights that we just heard, starting with the economic conditions, right? We still got these high interest rates plus the higher cost of living. This is why consumers have had to really continue to adapt to these conditions. But in many cases, we've got consumers also experiencing financial stress, which is why we're seeing, again, a lot more of those minimum payers, as well as more missed payments coming through. Last key item Becky just mentioned is, we're seeing through the data that, those that are stressed, they're seeing a negative impact on their scores. So in terms of what we're seeing here with regards to current and emerging trends, well, top spot goes to housing, because again, affordability continues to be a big problem. We've got new immigrants, as Bill mentioned, population coming in. We've got housing supply shortage, Plus, we've got these high interest rates, which leads to really driving cost up, both for renters and buyers. Again, it's not just the buyers, renters are also impacted. And in terms of inflation, again, those increased shelter costs, that's the biggest driver. But again, the high cost of basic commodities is also pretty high too. So this is where we're seeing really a clear shift in how consumers are adapting to these conditions, right? They're more sensitive, hence they're looking to spend less. They're looking to be wise about, what credit products they're using, what offers to take up, how to spread or even prioritize, which payments to make. And consumers are really clearly shopping around for the best deals. And they're very much in tune with checking and understanding their credit scores. Consumers know, right? The better the score, the better the rate. So lots of trends happening, but again, my favorite part is, talking a little bit about, as a lender, what you should be thinking about. So first off, we've got consumers adapting and changing their own behavior to navigate through sort of these conditions. But as a lender, you also need to be adapting, right? And again, depending on the region or the province, there's different impacts. So this is where, that tool segmentation comes in, and it becomes very important for your strategies and your product offerings. So depending on the consumer and, their price sensitivity, their needs for different types of credit is also changing. And this is where, it's important if you're looking to grow your business or you mitigate your risk, you're going to need to know, right, who needs more credit or who doesn't. And, we mentioned last week's rate cut, right? So for some, it might mean coming off the sidelines looking for new credit. But, as a lender, you need to be assessing, are they credit worthy? Has the financial stress impacted their credit score, and has their score actually been declining? You need to really assess and adapt your strategies to make sure, again, those product offerings are taking into account the different risk levels. So before we actually move in and throw a spotlight on the housing market, actually, we want to hear from you. We've got a couple of poll questions that I'm going to ask Sandra to push through. With the first one being last week's impact, right? 25 basis points cut on June 5th. Are you seeing any impact? First one being, I'm not seeing any impact, some impact, big impact, or it's too soon to tell. We'd love to hear from you. So this is your part to engage and lock in your votes. All right, we're going to give you another 10 seconds before we close out the polls. All right. Let's see what the results say. All right, so clearly the lead is that the majority feel that it's too soon to tell, followed with no impact yet. So yes, it's only been a week, perhaps not much activity, but I guess we'll wait and see what happens next. We've got another poll question for everybody. All right, so following last week's cut, what do we think the trajectory is going to be in terms of the next cut? Do we think it's going to happen on the 24th of July? We're going to wait till the fall, October, or December? Again, the Bank of Canada has stated they want to hit a 2% target. What does that speed of cuts look like? What do you think? Please lock in your votes. Give everybody 10 more seconds before we close off the poll and see what our audience feels. Oh. Okay, Sandra, show us the results. Interesting. So clearly there seems to be a unanimous, half the audience that voted seems to feel that September 4th will be when we see the next rate cut. And some are very optimistic that next month we'll see another cut. And obviously October and December, less folks feel that we're going to have to wait that long before we see the next cut. So on that note, Becky, I'm going to shift back to you to talk to us a little bit more about what's been happening with the housing market.
Yeah, thank you, Kathy. And I guess maybe just before we move on, Bill, what's your thoughts on the interest rate? Do you think July, September, October, interested for the economist perspective?
So I would go with the majority and say September, only because they really have taken a go slow approach. I think they're going to want to see how the market reacts. The fall housing market will sort of kick in, kind of August, September timeframe. My bet right now would be September, unless we see some weak numbers come through. If we see a big drop in CPI this week or this month, potentially they might go as early as July. I don't think they'll wait as long as October. I think it'll be likely September, but again, if the numbers weaken up a little bit, it could be as early as July.
Okay, so basically not good news for my mortgage renewal. Thanks, Bill. Okay, all right, so let's talk a bit more about the mortgage side of things. So probably unsurprising, really, there is quite a big slowdown in terms of the mortgage market here in Canada right now. Even when you start to look at things like new listings coming through in relation to sales, sales are still much lower compared to where they were kind of 24 months ago, and we're seeing property staying on sale for a much longer period of time. As we start to look at what's going on overall in the mortgage book, though, we are seeing a shift toward longer terms remaining, probably unsurprising. And one of the reasons, and we'll talk a bit more about it in a second, is around consumers and what they are doing to mitigate against some of those higher interest rates. So we are seeing terms extending out a little bit longer. Q1 did see the lowest period of originations that we actually have in terms of our numbers going backwards, though, very low volumes coming through. As Bill mentioned earlier, provincially, though, there is an exception to that, which is Alberta. Alberta has actually seen growth year on year in terms of new originations, and that likely is linked to that interprovincial migration that's happening. Individuals, particularly from Ontario and BC, they might be choosing to move to Alberta because those house prices are a little bit more affordable, or have been. They're obviously starting to increase right now. And as we kind of talked a little bit about already, that interest rate cut has been announced by Bank of Canada, but it is still a relatively small amount of movement in terms of what that means for individuals who are renewing their mortgage, looking to buy a new home right now, or have a renewal coming up. So if we dig a bit deeper in terms of what's happening with different parts of the mortgage market, first-time home buyers, unfortunately, they have been hit one of the most by affordability woes. They do tend to have higher average mortgage amounts, and affordability really hasn't helped them so far. So that middle chart right now, if you look, the red line is average loan amount. It has fallen a little bit as house prices have dropped slightly as a result of the interest rate movements. But unfortunately, monthly payment amounts because of interest rates are just hugely counteracting that. So it's much less affordable for first-time home buyers. And we've seen a 10% drop in terms of volumes compared to 12 months ago for those first-time home buyers. In terms of actual new property purchases, well, we did have quite a high period 12, 24 months ago. I think one of the interesting things when we look at new property is, compared to pre-pandemic, we actually have a much higher percentage of consumers with multiple mortgages. So individuals may be buying second, third homes. Now, whereas some of that may have been previously kind of to do with, actually just having a cottage or something else themselves, we likely have got more investment properties that kind of appeared during the pandemic that's really led to some of that. So around 5.6% of mortgage consumers have more than 2 active mortgages on their credit file right now. When we look at what's happening with renewals and refinancing, and again, probably unsurprising, we are seeing less refinancing happening right now because it likely just isn't a good time to be doing that. And in terms of when consumers are needing to come up for renewal on their mortgage, we are seeing a lot more switch behaviour. So we're seeing a lot more shopping around, perhaps using brokers more. We're seeing movements in terms of individuals switching to a new lender. The middle chart kind of talks a little bit about where that switching is occurring. So, for example, if we look at the big 5 banks, around 7% of their renewals are actually going elsewhere, which is higher than it was maybe 12 months ago. So again, individuals trying to get the best rates that they can, or perhaps being priced out of some of the options for certain lenders as well. In terms of the payment side, so again, interest rates are high, so payments, as you renew, are likely to go up. We are seeing, individuals where their payments are going up by more than $500 is a real risk area. We saw this last quarter, continuing to see it. As those payments are going up, that's where you are more likely to see financial stress, either on the mortgage or on the non-mortgage side of things. The average increase there, $1,483 if you fall into that population, which is quite a significant increase. The term extensions that we're seeing, though, this is one tool which consumers are using to try and mitigate against that. So we have around 12.9% of consumers have extended their term and still taking a payment increase. So that group, again, might be one to watch, just because potentially they are trying to reduce their payments, and even with what they're trying to do, they have still ended up paying a fairly significant more amount. Another 28% are increasing their payments without that term extension. So quite a significant population there where we are seeing those payment levels starting to increase. For some others, we are seeing some term extension of 24.3%, where they're extending the term and their payments may be staying similar. So again, it's a tool consumers are using right now, perhaps pay more interest as a result. We may be starting to see maybe some choices by consumers to go to shorter term mortgages, so that they can look at renewing maybe 3 years instead of 5 years down the line, when interest rates might be that little bit lower. In terms of missed payments, unfortunately, they are continuing to increase. The left-hand side is mortgage delinquency rate, a dollar and volume amount. We are seeing that dollar amount, delinquency-wise, increasing at a faster rate, and that's really because where that delinquency is coming through is some of the regions which tend to have higher house prices, so Ontario, BC, Quebec a little bit now, and we're also seeing it's some of the more younger mortgages where we're seeing the missed payments happening. So that's why that dollar amount is really outpacing some of the volume. In terms of provincially, you can see that right-hand side, Ontario is well above where it was pre-pandemic in terms of volumes. When you start to look at a dollar level, it's much higher as well, and that kind of carries for BC. So definitely seeing an increase in terms of missed payments on mortgages across the board, but really in those regions where the interest rates are having that higher impact still. So Kathy, maybe I can hand over to you, and you can give your thoughts on what does this mean for lenders in the mortgage space.
Right. So again, before I jump into that, just a little quick recap. Again, we've seen the market really cool down. And for those renewing, right, that we're seeing, again, increased amortization periods to manage those payment shocks, and quite a bit of lender switching, where consumers are clearly looking for the best rate. And from the regional perspective, like you just mentioned, Becky, BC and Ontario, they're leading when it comes to having consumers miss mortgage payments. So in addition to this, there's a few key challenges that are impacting the market. First one, obviously, being the high interest rate, high home prices. And again, we've mentioned throughout today the large number of renewals that we're expecting this year, next year, and in 26. So coming back to this clear shift in terms of how consumers are adapting to these conditions, we are seeing this in the mortgage market. We've got many folks that are delaying purchasing a house, right? They're extending those amortization terms. Again, or we're even seeing missed payments on non-mortgage credit products, especially in places like BC and Ontario, where the cost of living is so high. And again, consumers are really shopping around, looking for that best rate and the lowest payment shock. So in terms of the big question for lenders, what does this mean? And, what should you be thinking about? Again, mentioned consumers are really sort of adapting and changing sort of their behavior with regards to what's happening in the housing market. But again, as a lender, this is where you also need to be adapting. Retaining mortgage customers, right? Big key here. Look at your strategies. Help to look and understand, how can you minimize those attrition rates? Where do you have pockets where you've got more vulnerable customers that are, expecting a significant payment shock and might have a higher propensity to switch? And how are you helping them, right? And, are you looking at adopting any of the guidelines from the Canadian Mortgage Charter to help out? Again, do you have any segments within your book that are, clearly financially stressed overall? And does it appear like your customers are actually, starting to look around? You know, and I've said it before, and I'm going to say it again, right? As a lender, this is where it's really, really important to be getting sort of the latest and greatest in terms of credit refreshes, right? Or having some sort of a monitoring program that feeds you the credit information, showing you the latest on that customer's financial health, right? And again, and also some of the trended attributes to help you understand, you know, is that consumer doing better, worse, or are they pretty stable over time? What's their cash flow situation look like? Any early signs? We've talked quite a bit about missed payments. Again, really, really understand whether or not that consumer is changing means making sure you've got robust strategies in place that'll allow you to really pivot quickly. So pausing there, I think we're going to head back to the polls. We've got one more question for everybody to understand sort of what challenges you might be facing. So what is the greatest challenge as it relates to offering credit products? So, you know, is it having no credit for newcomers to Canada at origination, at point of adjudication? Is it the fact that, you know, you've got thin credit for new to credit at origination? Is it the payment shocks for existing clients at renewal? Or is it, you know, seeing an increasing trend on missed payments and delinquencies for existing clients? And sorry, last one, E, or insolvencies for overextended clients. You can pick more than one answer. So I know there's quite a few options there, but just choose which ones pertain to your business or what you see as a challenge. I'll give everybody another 10 seconds or so. Lock in their answers. What is your greatest challenge in terms of offering credit products? Okay. Let's close off the polls and see what our audience thinks or feels. All right, so top spot goes to payment shocks for existing clients at renewal, followed closely by the missed payments and delinquency for existing clients. Yep, and those are, again, coming back to what we've been talking about, those seem to be sort of the big concerns and the biggest challenges in the market. So Becky, I'm going to hand it back to you to talk to us a little bit about sort of non-mortgage products like cards.
Thank you so much, Kathy. So yeah, so I mentioned earlier, credit cards, we are seeing balances increasing year on year. So let's dig a little bit into where that's coming from. So in terms of new originations on credit cards, we've seen those increasing for quite some time. Again, heavily linked to immigration and population growth, but also just more consumers, I guess, using credit cards and needing a credit card right now. In terms of what we've seen in Q1 and a little bit in Q4 last year, we're finally seeing that growth start to slow down a little bit. So numbers are still high, but down from the peak that we saw, I guess, in Q3 of 2023. When we start to look a little bit in terms of where new card acquisition is from a scoring standpoint, we actually are seeing, I guess, more consumers coming through with a lower credit score. So we're seeing a bit more demand and a bit more lenders are still lending to lower scoring, and that's up, also down a little bit from 2023. In terms of the makeup of the credit card balance, we do look at revolver and transactor levels. So revolver being those consumers who aren't paying their balance in full on a monthly basis, and transactors being those that are paying in full. And when we start to look at the balance growth compared to 12 months ago, we are still seeing faster growth in that revolver population. So there's individuals carrying a balance over to the next month that is up 16.5% compared to 12 months ago, whereas on the transactor side, it's only 11% shift. We're also seeing that balance growth in lower scoring consumers. So across the board, the average balance is up around 10%, but when you start to look at that right-hand table, you'll see really from kind of like the 680 and down in terms of credit score, that's where we're seeing the biggest growth year on year in terms of balance. So as individuals are feeling that financial stress, they are paying less on their credit card, and those balances are starting to creep up. And unfortunately, that does kind of then feed into what's happening with missed payments, because one of the early warning indicators of missed payments does tend to be how consumers are paying on their credit card. We are seeing delinquency levels rising. The dollar delinquency rate not quite back to where we were pre-pandemic, but again, it's been steadily increasing since kind of those interest rate increases came in 2022 and those kind of high inflation cost of living periods. On a volume basis, which is the orange line on the left-hand chart, we are back now to the same level we were pre-pandemic. And again, it has not flattened yet. And I think that's the important thing when we talk about compared to pre-pandemic. It's not a case of we've reached and we've stabilized. It's still on an upward trajectory across many of the different types of credit products. Right-hand side just gives you a bit of view of minimum payers. They have been increasing, particularly for those with a mortgage. So again, as those mortgage renewals are coming through and payment shocks are having an impact on consumers, we're seeing an increase in the percentage who are just making their minimum payment amount as well. So Kathy, and maybe from a credit card side of things, what should lenders be thinking about given we're seeing these payments, given we're seeing balances going up and delinquencies rising, what should they really be considering?
Right. So in terms of, let's get to this right slide. Yeah. So in terms of the current and emerging trends and what we heard you just talk about, Becky, for cardholders, because we've got balances going up, right? The average minimum payment requirements have also gone up, right? And with these economic conditions, we've got a growing number of minimum payers in the market, which again is an early warning sign for delinquency. And if we look around the world, across the board, we're seeing many and a lot of consumers really relying on that credit card to get by because of the higher cost of living. And in terms of the delinquency rates, our friends down south beside us, they've actually surpassed their pre-pandemic levels. So coming back to Canada, again, consumers are clearly adapting by, needing to use their cards to manage the higher cost of living. But we're also seeing the data show us that they're not paying it down fast enough, which is why we're seeing, again, these increasing debt levels. Now, something else I actually just wanted to table, according to our data, we're also not seeing buy now, pay later grow in popularity in terms of a competitive threat that we've seen in other regions in the world, like Australia, where coincidentally, they just passed some regulation there where it's now mandatory for credit checks to be done by buy now, pay later lenders. So we'll see how that unfolds there. So coming back to pulling this all together and trying to sort of make sense of, what does this mean and what should a lender be thinking about? I've got a couple of thoughts to share. Again, we're seeing early warning signs in terms of delinquency coming through, which means as a lender, again, are you regularly looking and monitoring your book for these signs of stress, these pockets? And how are you mitigating them quickly? Are you looking at the overall picture of that customer, not just the on-book view, right? You need to look at the off. Like, what do they have? What other traits do they have? And are they experiencing financial stress elsewhere? You need to be looking at things like, what's their utilization rates overall, cash flow? Are they seeking out new credit? What are their repayment behaviors, right? Have they adapted and moved from being a transactor to a revolver, right? Have they accepted a balance transfer offer? We're seeing a lot of those pop up. Again, all of these are signs related to credit information that you need to be looking at regularly to understand, again, that customer's overall financial position. And so for adjudication strategies as well, again, the trend that we've been seeing is the newer vintages are missing payments, right? And that also includes consumers with like really high scores and good scores. So again, as a lender, you need to be looking at your policies, either tighten them up or make sure that you're looking at customers really closely to understand, again, are there any early signs of stress coming through? And I mentioned it earlier, segmentation, right? It's really important to leverage segmentation tools to understand, again, where within your book you might have pockets of more stress coming through. So let's put the cards aside, Becky, and I'm going to pass it back to you to drive us home with Otto.
Thank you, Kathy. Okay, so digging into what's happening in the auto space right now. So we know that during the pandemic, we actually saw a lot of challenges in the auto industry, supply chain issues. As a result, vehicle prices did rise, and we saw a lot of people switching to used vehicles and reduced supply and things like that. So the good news is in the auto space, We are seeing a little bit of a pickup in terms of auto loans. You can see on the left-hand side, that grey line. We are seeing balances starting to rise again, even though we do still have those high interest rates. And one of the reasons for that is really that we are starting to finally see some movement in terms of pricing on used vehicles in particular. On new vehicles, though, those prices are still very high. And so we are seeing a bit of a reduction in demand for leasing, potentially because interest rates are that little bit higher as well, and maybe not making the numbers on those deals go round as much. Where we are seeing some growth, though, when we look at the overall portfolio for auto, we're seeing more balance in the kind of deep prime, deep subprime, and subprime areas. So one thing to maybe look out for in your portfolios is kind of what's happening with that risk balance and how that might be changing over time. In terms of new originations, so Q1 was a strong quarter. It was higher than we normally would expect in terms of seasonality. You see that on the left-hand side, we are seeing leases have picked up a little bit, and loans as well. And the reason in the last quarter why leases have started to pick up is when you look on the right-hand side, we're seeing a bit of a reduction in terms of the credit limit, the amount that's kind of linked to those leases. So this doesn't necessarily mean that new prices have come down. It's perhaps more that consumers are starting to think about their options and maybe choosing a slightly lower value vehicle for their leasing. When we start to kind of look at delinquency levels, unfortunately, on the loan side of things, we are still seeing those delinquency levels rising, again, similar to some of the products as we already talked about. Leases, which does tend to be a little bit more of a prime product, is a bit more stable, a little bit of increase there, but not as much or not as evident as when you start to look at what's happening on the loan side of things. Right-hand side of this chart, this is a vintage view. So what that means is these lines are representing the open date of these products, and then the lines are 24 months later. So looking at kind of what's happened to those new originations within that first 24 months. And it's broken down by score. And you'll see on that right-hand side, it's quite evident, particularly the blue and orange lines, which tend to be more the kind of near prime, subprime populations. Recent vintages, we are seeing delinquency levels have been rising, and they are above pre-pandemic. So if you go back to kind of 2018, we are seeing much faster stress emerging in the auto space. So again, as you're starting to think about some of your pricing and things, that's something to be considering. Just breaking down in terms of used and new, so used car origination on the left-hand side again. It's up a little bit. It's still low compared to where we were. What's the most stark thing that we are seeing there? And again, back to consumers and how they are adapting to the current economic situation, we are seeing them take longer and longer loan terms, which is, helping to get the affordability down for them, or make these loans a bit more affordable by extending those terms out. The payments are coming down, but it is a significant shift compared to where we were going back to 2019. So you'll see that right-hand side, those bars, the grey is where terms are 84 months or longer. That's 7 years or more for a car loan. And you have 47.5% of the used car market are in that space compared to 25% back in 2019. So a huge shift in terms of the length of these car loans that are going through on the used car side of things. When we start to look at new car originations, again, a little bit similar. They're down, but they are picking back up again. And you see that left-hand chart, the orange line, that's what I was saying about average loan amount. So new car prices certainly aren't dropping, and we're seeing the loans associated with them continuing to increase. Right-hand side, probably not a great surprise. This is actually the interest rate that we're seeing on these new card originations. The days of subvention and 0% rates, which is the blue on that right-hand chart, have certainly gone and certainly aren't back yet, with interest rates being where they are. So we are seeing far more in that grey space, which is between kind of 5 and 9% in terms of the interest rate. So again, that's going to be having a material impact in terms of consumer behaviours and kind of the ability to buy a new car right now for a lot of consumers. Delinquency-wise, both new and used cars are seeing an uptick in terms of missed payments coming through. It is certainly worse on the used car side of things. And as you start to think about what I showed you on that a couple of slides ago around those terms being much longer, you've got much longer terms, which is good in a way, if you're a lender, because the interest is a little bit higher. earlier on, but the missed payments are really coming through on those. So again, that's going to put a lot of strain in terms of your portfolios if you are thinking about the risk and return on investment for some of those loans. If we look at this provincially as well, we are seeing across all provinces those missed payments coming through, particularly on used cars. So you see Ontario, BC, and Quebec, they are all well above their pre-pandemic levels. Quebec, interestingly, used to be really low in terms of the delinquency rate on these used cars. That has really increased. So again, a bit of a shock factor there if you're a lender in Quebec, probably on those auto loans. So Kathy, maybe you can shed some light in terms of, you can drive us forward, Kathy, on auto loans.
See, these jokes rub off. Okay, so really quickly, in terms of the current and emerging trends, right, we're actually seeing two big challenges impacting auto. Affordability and fraud. Those are the two. So if we double click on affordability, again, even though we've got like supply chain corrections and, you know, price points have come down, when you factor in the overall cost of living and the high interest rate, it's really still hard to afford a vehicle and afford those monthly fixed recurring payments. The other challenge that we're seeing really sort of be evident is fraud, right? We're seeing a lot more third-party fraudsters really using stolen ID for auto applications. So bringing this all together in terms of, again, that big question, what should auto lenders be thinking about? There's a few things that I just want to touch on, right? Again, we've got population growth coupled with, you know, higher inventory, which is naturally going to boost the demand. But again, affordability is still the concern because you've got those higher interest rates. And even with the first rate cut, right? As we all saw, we don't think much is going to happen right now. In terms of your education policies, you know, again, you need to monitor, make sure you adjust them because again, you've got more maybe riskier subprime applicants coming in. So again, look and assess and understand their cash flow, right? Can they take on a loan and take on those reoccurring monthly payments? On the flip side, again, just be mindful, right? If we get more rate cuts, those less risky customers in your book might start looking for an early payout and they might jump into a loan, right? With a lower interest rate, which means what are you left with? You might be left with a book that's a little bit skewed towards having riskier customers. And then you got to think about, you know, have I provisioned enough in case some of those delinquencies start to evolve into financial losses? Last item I just want to touch on, again, I've said it throughout, you know, a monitoring or triggers program, right? You need to be getting the latest and greatest on your customer to understand, again, how is their financial situation changing? Look to understand, again, are they on a slippery slope? Are they doing well? Again, being close allows you to make those necessary sort of mitigation steps really quickly and effectively because at the end of the day, you're looking to reduce your risk and minimize your losses. So let's park this auto talk here. I think there's been quite a few questions come in. I don't know if we've got time, Becky, but I'm going to pass it back to you.
Yeah, thank you, Kathy. And I know some of you did pre-ask questions as well when you registered, so thank you so much for doing that. Again, we have run out of time. We were just saying maybe we should do a separate podcast just to go through questions. A couple of people are asking around some of the comparisons with Canada and the US. Don't have time to go into all of the answers on that one, but what I can say is if you go to your search engine and type in Equifax Global Insights, we do have a quarterly report you can download that has key numbers from Canada, US, Australia, LATAM, UK. So, you know, go and download that report that we issue quarterly. It's got a whole pile of information. If you are interested in those key trends. I guess maybe, Bill, one quick question for you. Someone was asking around any key differences between Quebec and Ontario economically that you think might be impacting right now. I don't know if you've got any thoughts on that.
Yeah, I mean, real quick, I think it's really about population growth. So Quebec's been lagging behind. Their economy's a little bit slower because of that. And so, you know, they've got the affordability on housing, but, you know, they also have a big renter population. So I think in general, a little bit slower in Quebec, primarily just without the population growth driving things.
Okay, all right, fantastic. Let me see if there's one more I can get to very super quickly. Bill, just for you, do you think there's any chance of a interest rate rise anytime in the future?
No, something would have to go radically wrong. So no, they're going to be on a decline for a while. You know, I think there was another question about kind of where they end up. They probably try to get back to about three and a quarter 3 to 3.5%, but probably 3.25%. That's sort of what they're seeing as their natural interest rate. I think we'll see a decline, but it will be slow. That'll likely take to like 2026 to get there.
Okay, all right. So in terms of the other questions, I'm sorry we had so many come through and we're out of time. Like I said, we will figure out a way to either come back to you individually or maybe we'll do some kind of joined up thing so everyone can see the questions that were asked and some of the answers. A couple of things before we do drop. First of all, the survey, please do fill in the survey. It helps us to improve what we do on a quarterly basis for this session. So please take the time to fill that in. If you are interested in what's happened on the business side of things, we have our business credit trends coming up June 20th at 1 p.m. So this is the same time next week. So please take the time to register for that. There's a lot of really interesting things happening in the business space right now. So definitely it's worth a listen for that one. Apart from that, thank you so much for joining us. We will of course be back next quarter. And have a great day.